What is NFT lending? NFT lending is a type of finance used in the NFT market, allowing users to use NFT as collateral and borrow tokens such as ETH, USDT. After a certain period of time, the borrower will repay borrowed tokens plus interest and receive the NFT back. The borrowing and lending process is similar to the lending-borrowing models in the DeFi market, and is also similar to the real-life lending model when users use vehicles, houses, as collateral. The NFT market is small cap and low liquidity, meaning it can take days or even months for an investor to sell an NFT. Therefore, NFT lending was born to help NFT holders have easier access to capital through the use of NFT as collateral. At the same time, this model also contributes to increasing capitalization and liquidity for the NFT market. How does NFT lending work? For those who own an NFT and want to mortgage it, they can secure a loan equivalent to 50% of the value of the NFT, with interest rates ranging from 20–80%. In addition, the use of blockchain and NFT technology makes user loans more transparent and faster than traditional loans. Normally, borrowing with NFT only takes a few minutes, but traditional loans will take more time. Large value loans can take days to weeks to complete. NFT lending protocols always use smart contracts for transactions, so collateral will always be locked and protected in a vault managed by the project's smart contract. Lending steps usually take place as follows. First, the borrower and lender enter into a transaction and agree on terms such as interest rate, loan amount, loan term, etc. The borrower then transfers the NFT from their wallet to a vault managed by the protocol's smart contract. At the same time, the lender also transfers the assets into storage. Once the vault has fully received the assets and NFTs, the smart contract will transfer the assets to the borrower, and the NFTs will be locked for the duration of the loan. If the borrower fails to repay the loan in interest within the specified time, the smart contract will automatically liquidate the NFT. Types of NFT lending models. Peer-to-peer lending. The peer-to-peer (P2P) lending model is a form of lending between users, with the interest rate and loan amount agreed upon by the parties without going through a third party. For example, A is a lender and wants to take NFTs as collateral. He uses a P2P platform and collateralizes NFTs. A has the right to customize the loan amount, interest rate, liquidation conditions, and wait for a lender to accept the transaction. B goes to this P2P dApp and sees that A has suitable transaction terms. Then B can trade with Mr. A and lend them a loan. If the loan period ends, Mr. B will receive the loan amount and interest back from A. Conversely, if A cannot repay the loan, the collateralized NFT will be transferred to B. Normally, P2P lending will take place on NFT lending dApps such as NFTFi, X2Y2, and these dApps use smart contracts for the loan process like the example above. In addition, dApps that support P2P lending will receive transaction fees from lenders. For example, NFTFi charges borrowers a 5% transaction fee for each successful loan, no fee if the borrower defaults. Borrowers will not be charged transaction fees. Peer-to-protocol lending. Peer-to-protocol lending is a financial model similar to most lending protocols in the DeFi market, allowing users to mortgage NFTs and receive loan amounts from a liquidity pool. In general, this method allows borrowers to access capital faster without having to wait for lenders, but lacks flexibility when they cannot freely adjust the loan amount. The peer-to-protocol lending model has three main components, including borrowers. These are the people who mortgage the NFT and receive the loan amount from the liquidity pool. At the end of the loan term, the borrower is obliged to pay interest and the loan amount. Lenders. These are the people who provide liquidity to the pool and receive interest depending on the dApp. dApp. Lending dApps will profit from the borrower's interest rates, and if the borrower cannot repay the debt, the NFT will return to the dApp, not the lender.